Welcome everyone to 1 Million Minds. Today we have a exciting new guest. I'm excited about introducing Raghu, and we'll talk a little bit more about his background. But before we get started, how are you, gentlemen? Balaji, Raghu, welcome. How are you guys doing today?
Doing a lot better than I started this week. Yeah, the flu's going around, kids getting sick, all kind of fun stuff. It rained like crazy in LA, like it was dark, gloomy days, and now it's bright and sunny, so never a dull
That's
day.
Right.
good. And Raghu's joining us from London.
Yes. Hi.
London, yeah.
Yes.
So
I
we
mean,
have
yeah.
Texas, California, and London represented. So that's awesome.
Excellent. Thank you. Thank you.
Awesome.
Yes.
So there's a lot going on in the market. I just wanted to kick us off with just some background. We want to save a lot of time for the topic. Get to that quickly. But before that, I wanted to quickly just get some feedback from the team on things that are happening in the market, right? I want to start with the crypto market, talk a little bit of what I see in the AI space. Those are the two spaces that are really interesting to me. But yes, if everybody's been reading about the FTX collapse, and if you use your own token, and if you guys are, again, none of what we're going to say is financial advice, but this is what we are doing. If there's an exchange is using his own token as collateral, just be scared, because I did lose money in Voyager. I didn't lose anything in FTX specifically, or Celsius. But FTX being a market maker and Alameda, this is just a starting, right? There's going to be more contagion because of this. There's going to be more people exposed. Is all going to come out of it. So the market is not in a good place. But what I know is I have most of mine in BTC and ETH. They're holding a little bit better than the rest of the market, which kind of ties into some of the things Raghu is going to talk about. But also, I don't want to. There's one last thing. I'm just like talking about macro, right? Like there's a website called layoffs.fyi, which tracks layoffs going on in the space, and I've been projecting some things are going to get bad for 6 to 9 months. And I've been talking to a bunch of entrepreneurs in the talent management space, and they didn't think technology was going to get affected. But right now, what are we, 11 days in November, and we're about 23K layoffs as compared to all of October was 12.5 and September was 6. So I'm just saying, I think this is just the beginning of what is considered some serious layoffs happening. And it might happen for the next 2 3 months, or maybe 6 months, a year, whatever happens, right? Where I'm going with this is it might look bleak, but as a builder, as an investor, or somebody who's interested in learning skills, this is a great time to focus the energy on that. So what I'm doing is doing this, talking to experts like Raghu and Balaji, and understanding more about the space. So I think that's what I'm going to recommend everybody do. So if you're gonna, that's the doom and gloom, right? But things are still doing really well in some of the spots of this technology space, which is AI. There's, I think it's called AlphaFold, the Meta company that is now synthesized, can model about 600 million proteins, which means the whole goal is to get basically be able to treat any disease, right? So there's a lot of good progress being made there. I know we talked about generative AI a few times. So like if you are a coder and you are just a rookie coder now, GitHub has Copilot, which can actually sit with you like an experienced coder and help you finish coding. Replit has Ghostwriter. There's videos that are doing this with the generative AI. So all I'm saying is, if you are a builder, this is an amazing opportunity with so many things. You can't even use an excuse of, I don't know how to write. There's AI tools for that. I don't know how to do video. There are AI tools for that. You don't know how to code. There are AI tools for it. So all I'm saying is, if you really are looking at it and you like the space and you want to be looking at it for the next 2 3 years, this is an amazing time to start and build something, right? So, and also build your skill set. So do you guys have any thoughts on what's going on in the market? Any feedback?
Yeah, I think I'm sure Raghu has more thoughts on it. I want to pick on a few things that you were talking about, right? I think one of the things I am looking for is since the Twitter takeover and the layoffs, and is there a mass exodus going to happen? It seems like it's happening. Is there are some tweets where Musk is like threatening, like this is I'm going to bankrupt the company. What's going to happen to Twitter? Is that going to even exist anymore? Right? If people start walking out, maybe there is no Twitter. Maybe it's something else at some point. It's crazy. And as for the FTX thing, I'm not much into any. I have no idea what happens in the exchanges. Probably Raghu is a better person, but it's crazy that what strikes me in that whole thing is that very seasoned VCs, they put their money to work with this guy. How could they not know what happened here? Right? It's crazy. That's the part that I can't get over. So yeah, and the last piece is I think the OpenAI community, I think the DALI and others, I think now there's the API that we can, because I registered at your recommendation, Rajni, and now I got an email saying, hey, the API is now for consumption. So that's great for people who want to build stuff with this AI model. So good stuff happening there. So Raghu?
Yeah, good. No, I mean, you guys pretty much covered most of it. I think, see, what has happened in FTX is nothing surprising. I mean, if you look at the the Walker rule that came in when I was in the banking industry, when, some of the banks, not all of them, and also some of the broking institutions, they did have some, transgressions, so to speak, in terms of, customer fund segregation, right? And what we are seeing at the moment is nothing new. This is something that has happened in the regulated space, so to speak, and therefore now it has happened in an unregulated, free-for-all industry. So, yeah, it's nothing surprising. I think at least what I think is going to happen is obviously it's going to tighten up the regulations, as me and Balaji were talking yesterday, and things are going a little bit more stringent, which is good because a lot of people.
Is this going to fast track the regulatory landscape, right? Right? And if so, where is it going to be? The stablecoin space, or where are they going to start first?
Yeah, I think a lot of people are happy, not should be happy, who are screaming for regulation are going to use this to show, right? Like this is our Enron movement, right? Technically, it's happened in the public markets, and it's so hard because I don't think, to answer your question, Balaji, I don't think this whole ecosystem is so new. They don't even know where to look for problems, right? Now there will be a general, okay, are you guys using your own coins as collateral? That's a big red flag, right? All I'm saying is, do you even know that when you're starting out? And like this is, so that's the good thing is we are kind of what do they say? When the tide goes out, you'll see who's swimming naked. Now we're catching people who are highly leveraged. It's painful, but it's a great flushing out of the system. So those who are left will be the ones who actually paid attention to whether it was a decentralized model or a very sound system that is not giving you 20% return every month. You know what I'm saying? So these things were all too good to be true. And everybody, including me, went after this and we got burned. So we'll all learn, and I think the whole flush out will happen, and things could only be better because I'm a firm believer in the long term, where I see the market, or I shouldn't say the market, the whole blockchain space going. So to me, this is painful but necessary, is the way I look at it. I think from Twitter, nobody knows what's going on there, just because a lot of, to your point, if the engineers leave, I think five executives quit too, so there's a lot of turmoil. I know it's interesting to me, right? Because I'm in the process of acquiring companies, I'm doing due diligence, but everything is doing is nothing's according to the book, right? He comes in, he's almost doing experiments at a fast pace and failing in the public eye. In such a big company, it's okay when you're smaller, with so much visibility on it. He's still doing that. Like he puts a new feature and it removes it. He says, say $20. No, that's not going to work. Let's do $8. He's testing and failing fast. So I think he has a plan, but regardless, it's going to be a great success. It's going to go to zero. So those are the two extremes. So it's going to be interesting to watch.
Yeah, I think it's going to be renamed as Twitter instead of Twitter. So
People
are quitting in droves. Yes.
So Raghu, I have one question for you, because you are in this space, right? Is exchanges becoming this high interest deposit, or like a sort of a bank? Is that even a good idea? Right now, Robinhood is starting to do it. FTX did that. So that's what sucks in a lot of people, retail guys, right? That causes a lot of other pain. It's not like, for example, if I compare that to, I don't know, maybe it's a crude analogy, but let's say you go Ameritrade or some other exchange, which there is no concept of interest, right? So this is all new thing. Is that kind of causes more problems over time because people are now getting attracted to put their money there, sit there. They're not playing with it, just let it sit there and it's going to give me 6%. And these exchanges are taking that and doing whatever they want.
Exactly. That's been the model for the last couple of years, if you look at it, right? So that's how
Right.
these guys were trying to make money. So I think that's definitely a big red flag if you look at it from a regulator's point of view, because you don't know where the money is going, right? I mean, obviously, as Rajni was saying, if you're going to put in if you're going to mint your own coin and keep it as a collateral, I mean that's like it's a serious no, right? So yeah, I mean, this is again an issue that we've been seeing, and hopefully it'll all get sorted out soon. Hopefully.
Gotcha.
Perfect.
All right.
Yeah, that was good discussion, guys. I mean, it's just so much going on. I just want to, talk through with it because I can't talk about it with my wife, so this works out for me. So awesome. All right, guys. So let's, without any more delay, one of the topics that is like I'll just set it up, right? Like one of the things is from a learning experience. I'm trying to learn more. Is I'm more of a what I'll consider the ETF and a long-term investor. I've done that a lot. I also played around with trading, and I didn't do it for too long because I got burned fast. And I think just like most people, I want to get in and like, oh, it's a good way to make quick money, and then of course I got burned. So, but I'm always been wanting to learn more trading, especially in the crypto space. And I know that's at a high level what Raghu is going to talk to us about. So I'm really interested in getting to know a little bit about your background, Raghu, and kind of guide us through your journey and help us all, learn this a little bit more. So I'm excited about it. So handing off to you, Raghu.
Thank you. Thanks. I feel honored, and also feel happy sharing whatever little knowledge that I have with you, with the other people out there. Yeah, I mean, if we could just pull out a few slides and then we can just go through a bit of it. So yeah, I'm just I'm going to briefly touch upon trading BTC and ETH, especially. Um, so the reason I mean, obviously we're going to talk about why BTC and ETH and not the other coins. I think we have about 3,000 to 4,000 coins out there, and probably more coming, or some of them are dead, some of them are dormant. But these two are the prime movers of the blockchain industry, if you may. And I think that's one of the reasons I thought it probably makes sense to focus on these two and try to sort of build our wealth on these, rather than scatterbraining across multiple coins, analyzing too many data, and then it just becomes analysis paralysis. But anyway, thanks guys for bringing me in. So yeah, my background is I think I've just put a slide, which is the next slide, on my background a little bit. So yeah, I've been I'm a technologist and a trader. Well, I was a professional trader and a market maker. My expertise primarily lies in trading options, both vanilla and exotic, for some large bulge bracket banks like JP Morgan, ING, and a few. And I've also traded commodity derivatives with a large firm called Olam, which is a listed firm in Singapore, which is also, I think, 60 or 70% owned by the sovereign fund, which is Temasek, which is from where I started to learn the tricks of the trade, so to speak. I'm also a lecturer of financial derivatives, both in India and Belgium, with a couple of institutions of some repute. And currently, in the last 6 to 7 years, I'm on my own running a consultancy. I got a partner in Washington, and together we kind of build, statistical stroke ML kind of models to find meaning in the markets. To find some sort of a method in the madness, if you may. And yeah, I'm also running a small portfolio, systematic portfolio on the side. And yeah, like you, I do, I have a passion for AML. I do dabble with a bit of, PyTorch and TensorFlow and all that sort of things, specifically to get an edge in the markets. That's in a nutshell. Next slide, please. Yeah, so we'll quickly go about, these are the table of contents that I have. What is trading, and why, how is it different from investing? Why BTC and ETH, and what are the instruments available for trading? What differences are there between those instruments, and how to trade them? Where are the exchanges? What are the exchanges? And for finally, if time permits, we can even look at ideating trades.
So,
So,
Raghu, at this point, I have a very basic question. When you say BTC and ETH, I've heard different definitions. How do you see them? Like, some say BTC is a store of value; it's like gold. Some say Ethereum is programmable money. Like, why should we even be interested in any of these two things that we listed? What is it?
very, very excellent question. To be honest with you, I'm not looking at anything fundamentally from why BTC or why ETH. I mean, what I know is in the last 10 years, obviously the narrative of BTC and ETH have been well sold off, and you can see that these two instruments are quite liquid in the markets. When I say liquid, from an open interest perspective, from a volume perspective, these guys are big and huge and highly decentralized, and pretty much almost every citizen in the world, that would be a big ask, but I think maybe at least 60% of the humanity might have been touched by these two concepts, and they may be holding even a teeny weeny bit of BTC and ETH, and therefore I think these two instruments are, it's a trader's paradise because they are highly liquid, and they are 24/7, and they are so decentralized that not one particular entity can sort of squeeze or shake this market into their advantage. So that is how I look at these two instruments. I'm not, we're not even talking about it's a store of value or it's an inflation beater or all this sort of thing. So from a macro perspective, I'm sure there are certain credit to those arguments, but from the discussion that we are having now, it's purely I look at them as numbers that are fluctuating, and these numbers are tradable, that can profitable and dependable and reliable, trustworthy. It's not squeezable. So as simple as that. I mean, it sounds very crass, but where
we not care about not the technology behind it, but from a trading, all the macro setup is these two pass a lot of your filters to be considered to be good candidates for trading, correct?
Absolutely. Very well said. Yeah. But having said that, obviously we look at in the next subsequent slides that it is important for a trader to understand some bit of the underlying, as you rightly said. So for instance, let's say if you are dabbling in ML, right? Let's say if you are an econometrician, or if you're a coder who understands machine learning really well, and then you want to understand, let's say, how does the price of the BTC or the ETH going to change, say the next week or in a couple of weeks, and you have certain features, certain independent variables. Say for instance, the price of the BTC or the ETH is your dependent variable, and there are certain independent variables. For instance, you can say the interest rates in the market, or the electricity price, say in Costa Rica or whatever. So it also matters to understand some bit of technology behind these. But having said that, it's not it's not the absolute necessity. So you can always trade these as simple instruments. You just get in, get out, or whatever works, and you could be rewarded.
So, Raghu, I have a question. I mean, this is the first time I hear this term, like you are a trader, but you're looking at it as a number, because I have never looked at it that way, right? Whenever I'm looking at it, it's like money. It's like it's dollars, green bill, whatever, right? So, but then the first time you say it's like, oh, I'm just looking at these numbers. Like, is there a term for this? Like, who are you? Like, you're looking at all of this as just numbers?
I consider myself as a quantitative trader, or what they call as quants, right? Where you look at you do a lot of data munging statistically, and using perhaps machine learning a little bit. I mean, I don't want to keep abusing the word machine learning, because what I realized over my last 5 years of machine learning experience is, interestingly, many of these machine learning methodologies do not give an additional edge than your statistical processes. Having said that, machine learning is nothing but stats. It's an old wine in a new bottle to a large extent. So I consider myself as a quant trader or a quant. So what we look at is, like most of the quants in the banking industry or in the hedge fund industry, what they look at is this instrument tradable? Are these numbers that you see are not manipulated by any central party, or it doesn't is not getting squeezed by some an oligopoly or whatever, so on and so forth. So therefore that's all that matters, to be honest with you. And if it's decentralized in such a way that these are trustworthy numbers, then go ahead and trade these. That's the idea. So it's a quant. So obviously, I mean, as you rightly said, these numbers are nothing but the other side of the numbers is the dollars and cents. So yeah, that's
Gotcha.
yeah.
And the other thing I think you kept mentioning that these are very liquid. What does it even mean? What does liquid mean?
We'll talk about liquidity. So I think I probably jumped the gun a bit, but we'll talk about liquidity.
Yeah. Balaji is excited.
Yeah, yeah. That's good. It's good, man. I think I can feel the energy in here. So
cool.
Yeah, I mean, so like trading versus investing. So I think pretty much this slide is self-explanatory. So most of us, and most of us were holding on to a traditional job or whatever we do. We are all kind of passive investors, so to speak. What it means is, like, we listen to some, we do some bit of basic analysis. Maybe we have some tip from a friend or a colleague or from a broker, and then you could just go and buy the stock, or perhaps buy a cryptocurrency, saying that, oh, this is probably Elon Musk is going to buy it next week, so therefore let's go ahead and run him, and we buy and we hold on to it. So that's a typical passive investment, right? That's what everybody does. A lot of people do it. That's what they do lifelong, without giving much of a thought to the whole process. But trading is a lot more active as a process. It's a lot more demanding process, in the sense that one has to be extremely committed to trading, because the margin of errors are quite dangerous here in trading. If silly mistakes can literally wipe you off, and therefore, so trading is typically short-termish. When I mean short-termish, it could be for a day. I mean, there are a lot of day traders, although I, from my own experience the last 15, 18 years, I realized that the markets are, in the short term, quite random, what they call as, random walk down Wall Street. That's a very interesting quote, where a lot of things are determined by randomness. So to guess what the market's going to do the next millisecond is almost impossible. And therefore, I've seen a lot of day traders getting burnt. So I do not advise, such a process. But, if somebody has an edge, pretty much can go ahead and do it. And the kind of people who do day trading, like the large institutions, say for instance Citadel, or a few other institutions that are there, it's not a quantitative job that they do. It's a technology job that they do. What I mean by that is, they have large servers co-located next to the exchanges, right, where the microseconds or the milliseconds of the data flow matters, and then they have a little bit of an extra edge than their competitors, and therefore therein lies the edge, and they make some bit of money. And then they do this at a high volume, right, like McDonald's. And so they make a few small millicents, if you may, on a million trades over the day, and then that's how they make their bread and butter. But what we are talking about is slightly more like a weekly trade or a monthly trade, etc. That is the kind of thing that I do. So that's what we might, probably we will look at in the next few slides or sessions. So as I said, yeah, the returns in trading are typically higher than that you have in investment. I mean, again, you have to take it with a pinch of salt. But what I mean by that is, because you're committed, it's because it's almost like a job that you do. So you're getting in, getting out, and therefore you're putting back the profits, you're deploying back the profits into the kitty, and then therefore it grows larger. I mean, that's what is expected out of trading as opposed to investing, because investing is very passive, right? And you never know what's going to happen. It's like buying and holding or hodl in this.
Raghu, I'm kind of confused at this point. If I'm doing one trade a month and I'm trying to make money, what am I doing rest of the time? You say it's a full-time job, and you say it's one time.
No, not one trade as a month. I'm saying what I'm saying is if you're holding on to a particular trade, it could be anywhere from a couple of days to a week to a month. Is all I'm saying. Say the monthly trade.
I think, Balaji, I think it's a good question, right? I don't think there's also some, because I used to do more of the daily fantasy football, similar take. But even if you're an investor or a trader, you don't take 100% of your portfolio and put in one. Usually there's a percentage. Sometimes at any given week, I can play with more than 20% of my bag, because you can lose it all. So there's some strategy behind it. So it won't be that one trade you might hold for a month, but that's not the only trade you'll do for the whole month, right? So those are the other things.
So I'm just trying to understand what is the job. It's almost like a job. What is the job for the rest of the time? Is it just studying and number crunching and materials that we read all day? What is the job?
No, we'll talk about it. Yeah, you're right. I mean, it involves it's a collage of many things, to be to put it like that. So obviously you're going to be number crunching a lot, running some stats and all that sort of things. But also looking at, let's say, if somebody is a technical trader, which we will talk in the next slide, like one who's a chartist, because a lot of people who believe in charts, and because a lot of people who believe in charts, it works like Hinduism or Christianity or whatever you may call it. So it's a belief system, right? Self-fulfilling prophecy. So anyway, we'll touch upon this. So trading can be approached in multiple ways, multiple paths. So the three main paths that I know are technical, fundamental, and quantitative, right? I mean, there are a lot of different traders or different approaches. So technical trader is one who purely looks at charts. He's got, if you look at his multiple screens that he has, he would have like 20 different charts, and they all look like, it looks like a NASA dashboard, and as if they are like monitoring a rocket in Mars or something like that. So it looks complicated. Obviously, things like moving averages, MACD, Bollinger, blah blah blah. They're like, there are a multitude of charts out there. Anything that is, you can even build your own set of charts. It doesn't matter, right? You can build your own things like, Fourier transforms. For those of you who have done a bit of engineering long ago, Fourier transforms, or things like Kalman filters, and there's so many out there. And then the fundamental guy is a guy, typical analyst, as we talked about yesterday, right? Like analyst is all the analysts that you see in the market, the equity analysts, they are all typically fundamental guys. What I mean by that is they take the balance sheet and the P&L statements, the cash flow statements of the company, and then run them through an Excel sheet, and then punch the numbers, and then arrive, like, do some DCFs, like discounted cash flows, NPV, IRR, and arrive at a number, and that number should be ideally the theoretical price of a stock. And if that number is, perhaps, if let's say if it is less than the price of the stock that gets traded in the market, they think the stock is overvalued, and then they go and sell, or vice versa. So that's your fundamental perspective. In our case, in the cryptocurrency case, things like, say, as I was saying, electricity prices, the GDP of a country, or so many other things perhaps could matter to the price of the end guy, which is, say, BTC or ETH. And finally, quantitative trading is, as I was saying, like, a guy like me looking at mathematically looking at things, like, say, build a machine learning model, an econometric model, where, let's say, if the change in the price on a daily basis, let's say, is your dependent variable, Y, and if you have multiple features, it could be hundreds of features. Obviously, you're going to be doing some feature engineering, etc., and then you come up with a model which sort of tells you where the market might be in the next day, or in the next few days, or maybe in a month's time, and then you take action on it. So that's the quantitative angle to it. But you can have a mix of these. I mean, anybody can have a mix of these different angles to it. So it's entirely up to a trader's preferences, so to speak.
Yeah, I mean, I follow a lot of the YouTube analysts, right? A lot of them do I'll call them more technical analysts, because one of the like fundamental analysts, let's just talk about that for a second, right? Because if it was a S&P 500 stock, you at least know they're making some money, you can do a DCF. But when you look at something like a Bitcoin, it doesn't really make money, right? It's more of a perceived value. ETH at least has a revenue generation wing to it, where people are using it to buy and it's burned. You know what I'm saying? Like that, there's at least some models we can use. So it'll be interesting to see. And a lot of the crypto will never pass a fundamental analysis, right? So it'll be interesting to talk about how you do this, especially for BTC, because I get the technical analysis is almost like a sentiment to me, right? But I'm oversimplifying it, but I've seen some of that. But to your point, if there's a combination of this that gives you a little bit more pulse on the underlying asset, that'd be great. I'm interested in knowing more about it.
So
when I see, sorry,
go ahead, Rahul.
No, go on. But sorry.
No, I think one of the thought it immediately strikes me is like a couple of thoughts that's in my head when I'm listening to you, right? One, whatever I learned here, can that be translated to the traditional markets, right? It looks like that's a big if. The reason being, like Rajni said, I think I went to this blockchain course from Wharton, and people are still trying to figure out how to value these. So thereby, this fundamental piece is still very rudimentary, and nobody knows how to evaluate these things. A technical, like you said, is like a religion. Sure, there's probably a whole bunch of people in that camp, because there's fundamentally you can't figure what's going on. Probably you can look at the charts, and quantitative is pure math based, and probably those two appeal to the crypto at this point. Maybe not the fundamental, but once that evolves into something that people can understand, maybe it's useful.
Yeah, that's a good point. Actually, when I say fundamental, I think probably I have to rephrase myself. Let's take it as a statistical. Say, why is the price of BTC? It depends on the hash rate and the electricity rate. So there's a lot of variables that perhaps like a multiple regression problem. And then if you're able to solve it to some extent, that could be one of the models, one of the perspectives that you can assume in the case. But as you rightly said, it's quite difficult to from if you're going to compare apples to apples versus say with an equity market, is difficult. This is a different market, as you said rightly. So yeah.
Right. So maybe thereby that's where probably the opportunities lie, because it's completely different, or it's sometimes it just have to be different to create opportunity. The second question or thought I had is this concept of, while I'm listening to this, I'm also going back and thinking, is this of any use to average person? Primarily because of two things you said. There's people taking their machines and co-locating close to the exchanges. Maybe it won't work in a decentralized world because there is no one place to co-locate to get that high-speed knowledge, right? There's high-speed frequency trading, or whatever you want to call it, in the regular markets. It's almost like retail has given up, right? Computer's going to win anytime, right? Every single time. So why am I even bothered trading? I think if I look at it from the crypto world, it could very well be it could get even worse, because now everything is done by the computers. So thereby you can latch onto it with some algorithm, and you can do your own version of it, and it's still a computer. So where does a human come into this trading part? What use do I have as a human being in this whole business?
Well, yeah, I mean, you're right. See, the human being is needed because he's the guy who understands what features. Let's say if you're building a simple statistical model, right? Like, while I have, as I said, while I have a lot of respect and faith in machine learning, I also said that there are certain, I won't call loopholes, a certain lacunae, if you may, right? There are certain drawbacks in machine learning, which is, let's say, take deep learning, for instance, right? I mean, it's a black box. Nobody knows what's going on inside. I mean, you put in a bunch of features, could be 100, 200 features, and then the machine spits out saying, look, BTC is going to be like, going to go up by 2% tomorrow, or it's going to drop by 6% the day after. That's quite a dangerous way to look at markets. But what we have seen, I mean, in any other industry, like even in let's take chess, for instance, right? I mean, today, if you look at the industry, the chess game as such, right, we have advanced leaps and bounds in terms of building great machines. But at the same time, even today, the intuition that a human brings, right, the gut feel of a human being when he is competing against another human being, that cannot be still replaced to a large extent. So the machines are there. Let the machines help you to. The machines are there to help you to look into the patterns, to look into things that are not very easy for an average Joe to look into, right, from a human perspective. And that's why it is a blend of both. So while you're right in saying that, yeah, machines, it's going to be the future is going to be machines are fighting with each other. So hundreds of algorithms going to fight with each other. The guy who builds, the people who are going to build these algorithms are also equally important, and that's why I think
right. My question is, yeah, there you go, you got it right. Like I'm imagining while you're talking this world where machines are doing what they do and quants are the puppeteers, right? So what does a person like me do? That's what I'm trying to figure out. What do I do? Right, you guys are puppeteering the whole thing, and what do I do?
Oh, well, you can probably join one of these. See, there's so many of these social trading companies, right? Which are, where you're able to actually participate. Let's say if you have some dollars, and if you say, look, I don't know any of these things, but I believe in this guy who has certain track record, who has done, is reasonably shown some good profitability. Look at his Sharpe ratio, his Sortino ratios, and so on and so forth over the last couple of years, and say, okay, this guy looks dependable, trustable, he understands, and his models are doing well. So let me invest, let me back him, right? So that's one of the ways that you can perhaps participate in this market. But if you are a little bit more adventurous, you can do your own modeling, right? I mean, that's where Rajni was saying. I mean, being an AI ML enthusiast, I'm sure he would have a lot more insights, than an average Joe who who doesn't understand much of these things. So if you have that sort of knowledge and skill set, then go ahead and please go and build these models and enjoy it. I mean, it's fun, and then they participate in the challenge.
Interesting. Okay, got it.
I don't know if you guys are aware, there is a tool called Composer, which is a tool that you can for this. When you ask the question, Balaji, what is a person who's just starting out, does not have this kind of background that Raghu has? Where do I even play with it? Composer is a tool. It's an AI tool. You basically decide on your risk level where you want to play in, and it gives you certain models. It's an easier tool for you to get your feet wet. Not saying you go all in, but at least get a sense for everything you can do, and you don't have to know a lot of basics. It's almost like a drag and drop thing you can do. It's something that I have just started exploring. It's a nice tool for a rookie like me to be able to, not, I won't be able to perform like what Raghu can, but you're not starting at zero, right? So
gotcha. Okay, got it.
There are a lot of tools like these. Yeah, I mean, that's true. So anyway, although all of these things sound very complicated, trading is not complicated. At the end of the day, if you look at trading, what is trading? Market goes up when there are a lot of buyers, when too much of money, too many dollars chase few little goods, right? And vice versa. The market goes down when a lot of sellers, people don't want to buy it anymore, and then they're going to be dumping the market. And as simple as that. If people stick to simple, basic logic in trading, like for instance, if you look at the price going up, the volumes going up, there's enough open interest. We'll talk about open interest anyway, and then you realize, okay, this market looks bullish, and therefore let's jump in and perhaps buy some. And also the vice versa, the market is going down, the volumes are increasing, but the price is going down, which means a lot of volumes, people are selling a lot more. It looks like it's going to plummet, right? So basic ideas, nothing very complicated. It still works. I mean, at the end of the day, it's not complicated. It's simple logic that works in trading. Contrary to popular belief that it is some big woo-woo and all. I mean, don't get me wrong. Like in the banks that I used to trade with, where I was saying where we were trading exotic options, those are all really complicated mathematics, etc. That is completely different. That doesn't involve us. Involve the regular markets, etc. So regular markets, if you're simple, observant, and regimental and disciplined, easy to make money. I would say that.
Excellent. So that's the next logical question. What is the base criteria for people to participate in this? Like you said, right? Are you observant? Are you paying attention? Are you ruling emotions out of the picture? Okay, that's interesting too. Okay, got it.
Excellent. Yeah, no, that's right. Yeah, you got to be numerate, you should be able to understand. You should be able to multiply, 7 into 2, that sort of thing. Basic numeracy and simple logic, right? When market goes up, buy when the market goes up, sell when the market goes down. I mean, this is a very interesting way. When I started trading, it's quite counterintuitive if you look at it, right? When the market goes up, what do you do? People say, my boss asked me, what did you do? I said, sell. He says, no, when the market goes up, you should buy. When the market goes down, you should sell. And it took me a year, almost a year, to understand this such a simple, naive concept.
That's contrary to everything I've ever heard, right? It's almost like when there's blood in the streets, go by or whatever, right? But you're saying the opposite? That's interesting.
No, it's not like I'm saying when the market goes up, right? The market is strong. When the market is strong, everybody is buying it. What do? You buy, right? I mean, look, obviously, it's not a statement written on stone, but this is a very basic logic if you look at that. So if things suddenly perk up, what do? You go and buy, right? Things are moving up. So therefore, you buy at some point in time. You got to buy it, and vice versa, right? If the market goes down, you should sell it. So obviously, if the market has gone down, say 20%, you can't go and sell it there. It's not. You can't sell it at the bottom. What I'm saying is, so these are certain clues. So the other thing is about markets is there are no hard and fast rules, which we will talk about. But there are no hard and fast rules. There is no holy grail. There are no secret formulae that tells you that look, this is what you should do, and it's a very what we call in our parlance a very stochastic game. Okay, it's very it is. And interestingly, 70% of the time, or I would say even 80% of the time, markets are range bound, which means they trade within certain range. Up and down within sideways. Whipsawing, so to speak. But the rest of the time is when the market trends. So these are the times when people have to look out and say, okay, look, there is a bit of a change in the state of the market. Perhaps this is a good time to jump in. Either ways, buy or sell or whatever. Yeah.
I think you can have, because I think Balaji, it's also a transition in your frameworks too, right? Because what you're saying is absolutely true. But when you're looking at a long-term trade, if it's down, you're buying. But it's also the other thing is you never fight Mr. Market, the market momentum. I think when you're looking a little bit more shorter frame, if the market's moving up, you just go with it, right? So again, that's because you're looking at a much shorter time frame. You're not looking at I'm going to invest in S&P 500 for the next 10 years. You're looking at a short term, so you can't really fight momentum. Momentum might not be the right word, Raghu, but that's what's the easier way for me to.
No, I think you're right. Yeah. So gotcha. Basically, what he's saying is you respect the market. She's the mother of all, to be honest with you. I mean, don't spit against the wind, so to speak. Right, so that's the idea. So anyway, I mean, going further down. We discussed this a little bit earlier. So I prefer BTC and ETH, and we also touched upon these points that they are quite active in the market and quite completely decentralized in a way that a lot of people are trading these geography agnostic and so on and so forth. And I also believe that these are. Interestingly, so we look what are the different asset classes so far that we've had traditionally speaking, right? For anybody, we had equities, we had bonds, which is fixed income. Then we had forex, FX, which is a never sleeping market. Then you have commodities, right? And so these are all your traditional asset classes that have been there, and they're going to be there forever. But these, because of the new technologies that have come up, which is beautiful blockchain technologies, we are seeing these. Interesting cryptocurrencies that have also sprung up. So I think it's a very interesting way to look at where if you have a portfolio and then you have like 100% say into, let's say if you've got 60% into equity, 40% let's say in fixed income or whatever, maybe you can pull out 10% of your total portfolio and dabble with these two guys, and that kind of gives you a little bit of a diversification risk, and also perhaps that also can improve the alpha, as the alpha is like how much can you beat the market by, right? That's the alpha. So that's something which is quite appealing to me from a trading perspective.
I'm glad you said that, because that's the way I'm looking at it too, right? Like you're not playing. I'm playing with more house money. I was trying to get to 10%, but what I convinced my wife was we need at least a little bit of exposure. So we took a portfolio of everything. We have real estate, we have stocks, and your 401k, and your company stock that you work for. So there is risk everywhere. But if you can take 5% of the portfolio into the crypto market and play with it, it's a 2% now. So that's a different story. But the bottom line is exposure to that has a higher alpha to what Raghu was saying compared to all the other ones. So if you are interested, that I mean, I shouldn't say for everybody else. For me, that number made sense, and that's what I'm trying to do at least for the next 10 years and see. Hopefully, I still have a wife by then, but hopefully the crypto market and my learning of the market will get better, right? So let's see.
So one thing that's fascinating, again, I don't have that much expertise in this area, but the first thing when I got exposure to the blockchain and these currencies and these coins and prices, because I don't have any exposure to the currency trading, this is never sleeping market. So how does an average person like me, because I don't want to think about anything when I go to sleep, but this thing won't let you sleep because it's always something going on, right? So this is what I'm trying to, again, as a very average trying to frame of mind, right? Okay, if it's a stock market, I can say, okay, I wake up from Pacific Coast, it's let's say 6:30 a.m. and everything goes to, it's done by 1 and I can still enjoy the rest of my life. So now going back to Raghu's point of it's a job. So what was an 8-hour job is now 24-hour job. What do people do when these kind of things? What do forex traders do? Is it like you're always awake, trying to figure out what's next and which part of the world is in conflict and where it's going to get?
Well, no, yeah, I mean, like if you're a portfolio manager with a large hedge fund, I know a lot of my friends who do that, right? I mean, they don't sleep. Obviously, they mint like crazy. I mean, obscene amounts of money. But like, you're right. But that's the whole idea that one, you got computers to help you out with these things, right? And two, things like risk management, which we would talk about, which is extremely paramount in trading, right? I mean, you're not going to be, let's say, buy ETS today or whatever, and then leave it there, because you're a trader. You know that probably 60% of the time, your ideas may go wrong. The other 40% of the time, if you can make money, your expected value, as they call it, still, if it's positive, which means you're a good trader, right? So you would have stop losses built in your trading strategies, right? And those stop losses are extremely important. What I mean by that is, like, you cut your stops. You should never cut your profits, but you always cut your losses. So that's as the trading dictum goes. So I know. I mean, even the regular markets, for instance, right? The equity markets today, they are not 24/7. I think they are 23 hours or 22 hours by 5. Look at S&P index, for instance, right?
Right. There's holidays.
It goes on. Yeah. But other than that, S&P goes at least from a UK time point of view. When I was trading it, it goes all the way up till 9:30 in the evening, and then it starts again at 11. It goes through the night. S&P doesn't sleep, right? So it had a break of an hour and a half on a weekday. Obviously, the weekends are closed. So if you think about it, then it's just like cryptocurrency. These guys are also not sleeping now, right? So yes, that definitely adds to the pain, but that pain can be easily assuaged or ameliorated if you are able to put in right stops, if you are able to keep things tidy from your logic perspective, from your computer's perspective, and you can leave your broker's orders, which are quite stringent and tight. You can manage your risk. It's not a big problem.
Got it.
Yeah. So can we? Yes. So the instruments that we that are available at the moment in the market are, typically you have the spot, which is nothing but the pure BTC, right? Like, say if it's trading at whatever $16,000 today, if you're able to fork $16,000 and say, okay, I want to buy one BTC, be my guest, you can do that. That's your spot or cash market, right? That's simple. That's like your stock. Let's say going into stock market, right? You got an equity and you want to buy into, let's say, Apple or Amazon Twitter or whatever, and then you go and tell your broker that I want to buy 2 stocks, 20 stocks, 100 stocks. Then so that's something that I don't dabble in the options market, which are also known as the derivative market, and what Mr. Warren Buffett famously used to call the weapons of mass destruction. I mean, there is a saying that because he doesn't understand, well, he does, but he kind of disparages these markets. But having said that, having been a derivatives trader for more than 1.5 decades, I can vouch for the fact that these are tameable wildlife, if you may, and they're quite interesting and challenging to trade, but they definitely have good rewards if properly done.
Gotcha.
In this section, probably in the next 5 or 10 minutes, we just talk about futures. We're not talking about options, which is a lot more complicated. Maybe if time permits, in the next few sessions we can talk about options, but we'll just briefly look upon futures, and we'll only look at futures in a centralized fashion. We're not going to be looking at decentralized trading of these futures. I think there are a few exchanges right now in the crypto space where there are futures that are getting traded in a decentralized fashion, but I have not dabbled with them, and I'm not familiar or comfortable with them.
So, Raghu, I think at this point I have this very basic question. You mentioned decentralized exchanges, and with the debacle from FTX, they're centralized. So what is decentralized? What is centralized? When it comes to exchanges, what does it even mean?
Well, when something is regulated, for instance, let's say Deribit, which we would look at, we'll talk about briefly. I mean, I have a small screenshot from Deribit futures in the next slide or so. Deribit is wholly located within the US, and it's monitored by the SEC and the CFTC, I think, and therefore it's highly regulated, which means that there's a lot of comfort from a trader's or investor's perspective that it's not going to go the FTX way. So a centralized exchange is simply that is regulated, right? A decentralized is obviously, as the name says, it's just up in the air. It's not registered. To put it legally speaking, it's not registered in under any jurisdiction, geographically speaking. So
Right.
Decentralized exchanges are out there. Like Uniswap, for instance, is a large decentralized exchange, and you just go in there, you swap your BTC for ETH or your ETH for Solana, so on and so forth, and you pay a fee, maybe in some coins, right? Maybe it could be ETH as a fee, as a gas fee or whatever. But centralized exchanges are registered exchanges, registered under certain jurisdictions, right? Deribit, that's one of the largest in the US. So it's easier to trade through them because you're rest assured that they won't go under, at least. So let's say CME, for that matter, right? CME has Bitcoin and Ethereum. I don't touch them because the margin amount, as we could see, I've just put it there, is about $23,500 today, just to trade one lot of Bitcoin. Just one single lot of Bitcoin. The minimum amount that you have to invest is $23,500 from in CME. But that's not the case with Deribit, which we would look at because they have fractional lottages, which is good for for us to learn trading and pick up the nuances. So I like Deribit, and I also like Binance, but not to the extent of Deribit. I kind of have a lot more comfort with Deribit than with Binance. But having said that, Binance is a lot more. They have a lot better products. They come up with interesting products, and they offer better leverages. That's
this almost begs the question, right? So if you are innovative in a positive way, right, you don't want to be regulated, right? You want to be innovative first, and then regulation come in later and take control of that, rather than thereby creates this kind of a zigzag movement, right? Because somebody who's innovative is without knowingly they're taking more risk and they're trying to figure that, but people who are trading in that platform take that risk, right? Because that's what you're trying to say. Like if you go to Deribit, it's completely overseen by the SEC. That's ultra conservative. They're not going to play with any new ideas, until someone tests it in the wild and brings it back. Is that kind
Yeah.
of analogy? Okay.
That's probably one way of putting it, right? You're right. Like, yeah. So, for instance, an exchange which is decentralized can have a binary option. Say, for instance, a binary option is like a binary bet, where let's say you bet on an event, right? And let's say the event happens, you put in $100 and you bet that if this event happens, I would receive a payoff of $1,000. But if this event doesn't happen, I lose all the money. So that's called as a binary option or a binary bet, which is not allowed in the States at the moment. If you go in the United States, I think it's probably quite regulated, quite stringent, but you can do it in a decentralized fashion. But as you rightly said, in centralized exchanges, you don't have that kind of breadth of products, which is good, because we're not looking at breadth of products. We want to make money at the end of the day.
Right.
Why are we here? What are we talking about? The whole dialogue that we're having is,
Gotcha. Okay. I got some understanding out of this. Thanks.
Yeah. Again, just going back to futures trading, I think probably some of these you guys know, or pardon me if it's a repeat, but yeah, it's a derivative contract, a futures, right? Like a BTC futures, and the payoff is like a linear payoff, just like a stock market, right? What I mean by that is, like, if you bought your futures at $100 and the market went up by market went up to $2, so you make, your profit is $2. Obviously, it depends on the leverage, right? I mean, I'm saying, if we'll talk about leverage in just a bit, but the payoff is linear in the case of a futures. So Y equals X is the payoff, like a stock market. Futures have expiry dates, which means they expire. They have a shelf life, right? Like a carton of milk in your refrigerator or whatever. So they have a shelf life, and then if something goes, I mean, sorry, just got distracted with the.
We have a storm going through here, guys. So I lost power, so I'm back with some mood lighting. So hopefully you guys can see me and hear me.
Yeah.
Oh, yeah.
We can still hear you. Yeah. Coming in okay. Uh-oh. Something happened to Roger.
We can only have two people at a time, apparently. No, I'm just kidding. But anyway, it is very interesting, the futures side of things, because there's a website called the Long Put. What I'm saying is there's a lot of slowdown in the market right now, right? But in general, if you expect the market to be in a different place in the next 2 years, how do you use it? The information.
The futures, you mean? Sorry, Rajni, I didn't get you there.
No, I believe the question was that if you kind of take a stand on a longer term perspective, okay, so the market is going to be here in 2 years. So he was wondering, how do you take a position on that? Let's say I think the Bitcoin is going to, or whatever, the cryptocurrency market is going to boom in 2 years, right? So if you have a long term thought process like that, and you want to take a position now, how do you take a position now? Like, what instrument?
Going back to what we talked about in the investment thing, if you have a 2-year perspective, I would recommend that you just go, let's say if you're long, if you're bullish or bearish, whatever, you can just do the cash, right? If you want to buy a fractional BTC or fractional ETH, just go long or short and keep it. Well, you can't go short from a cash perspective. You can only go long. But if I can, that's a good idea. I mean, so if it's a long term, you can still use your futures. I mean, you need to keep rolling over. Maybe if time permits, we can perhaps continue this whole session the next week or the next session.
Well, absolutely. I think all of the information you gave us today is fantastic. I mean, it gives a good starting point to a lot of other conversations that we want to have over the next a few oncoming episodes, right? I think it just sets up the stage. I think it's wonderful information, and I personally learned a whole bunch of stuff while interacting with you. So I hope others do the same while they look at this episode.